I want to be perfectly clear right from the start. The next 6 years, the period stretching out to roughly 2030, will be the most volatile, financially decisive, and potentially wealth-defining period that most of us will ever experience. This is not hyperbole designed to capture attention. It is a cold, hard assessment based on analyzing the impossible mathematical corner that global central banks and sovereign governments have painted themselves into. If you are holding conventional paper assets, if your retirement plan relies on the continuation of current debt-to-GDP ratios, or if you believe inflation is merely a temporary blip caused by supply chain bottlenecks, then you are operating under a fundamental, deeply dangerous illusion. My career has been built on observing market fundamentals and taking the contrarian position when those fundamentals diverge violently from narrative. Today, the divergence is not just a gap, it is a chasm. I am not simply moving capital around the edges of the market. I am executing a fundamental, all-in structural shift based on one inescapable truth. The debt bubble has burst, and the only remaining policy tool is the deliberate destruction of purchasing power. The question is not if your dollar will lose value, but how fast and how completely. This 6-year window is critical because it represents the time frame during which the interest payments on the colossal global debt incurred through years of reckless quantitative easing and pandemic spending, will finally consume the capacity of the productive economy to service it. We are already seeing the early stages of this unwinding. Historically high and persistent inflation that governments desperately label as transitory, rising interest rates causing severe stresses in regional banking and housing, and the geopolitical fragmentation that forces nations to reconsider the sanctity of fiat reserves. I see the central bankers as firefighters who have run out of water and are now attempting to extinguish the blaze by spraying gasoline. The gasoline is the continuation of negative real interest rates, managed decline of the currency, and the eventual, inevitable pivot back to massive money printing when the recessionary pressures become politically untenable. They cannot afford rising rates because rising rates bankrupt the governments themselves. Therefore, they must choose inflation. This is the bedrock of my entire thesis. The conflict, then, is simple. It is the battle between paper promises and physical reality. On one side, you have trillions of dollars in sovereign bonds, derivatives, and fractional reserve banking claims, assets that are nothing more than liabilities on someone else's over-leveraged balance sheet. On the other side, you have tangible, irreplaceable assets, commodities, productive land, energy infrastructure, and most importantly for my focus, assets that function as true, historical monetary metals. To thrive or merely survive over the next 6 years, you must own the latter and aggressively divest from the former. But the key to achieving exponential returns, the kind that truly outpace hyperinflationary pressures, is not simply owning the assets, it is understanding where the leverage in the supply chain exists and positioning yourself there before the institutional herd arrives. This requires precision. Let me elaborate on the environment we are currently navigating. We have witnessed a decade of ZIRP, zero interest rate policy, which was supposed to be temporary, but became permanent because the system became addicted to cheap capital. Governments expanded spending with the explicit belief that deficits do not matter. Now, we have an inflationary hangover coupled with a potential recession, a phenomenon known as stagflation, which is the most lethal environment for conventional stocks and bonds. Why is the current inflation structural and not merely transitory? Because the inflationary pressure is fueled by two primary unfixable levers. First, monetary policy. The central banks have printed colossal sums of money, far exceeding productive capacity. This new money is now washing through the system, creating demand inflation. Furthermore, the governments have structurally increased entitlements and spending commitments that require continual deficit financing. This requires the continuous debasement of the currency they are printing until the system breaks. Second, the energy transition and supply deficit. We have artificially starved the traditional energy sector of capital in the name of ESG, environmental, social, and governance mandates, while simultaneously demanding more energy for digitalization and electrification. Mining, the sector I specialize in, is incredibly energy intensive. When energy costs soar, the cost of extracting every single ounce of gold, silver, copper, or nickel also soars. This means the floor price for all commodities is rising structurally, independent of financial demand. These forces converge to make negative real interest rates a permanent feature of the landscape. Real interest rates are the nominal rate minus the actual rate of inflation. When real rates are deeply negative, holding cash or low-yielding bonds guarantees a loss of purchasing power. Historically, this environment is a siren call for gold and silver. It is the only place where capital can hide and maintain its value. Now let me move to the core of my investment thesis for the next 6 years. It is centered, uncompromisingly, on the monetary metals, gold and silver. Gold is the insurance policy. It is the ultimate store of value. It has a zero counterparty risk and has served as money for 5,000 years. When the dollar eventually loses its role as the world's sole reserve currency, a process that has already begun, accelerated by the weaponization of the dollar, nations, institutions, and eventually individuals will flock back to physical gold for stability. We are seeing central banks, particularly those in the East, buying gold at near record pace, implicitly signaling their lack of faith in the dollar system. They are not waiting for the collapse. They are preparing for the transition. However, owning gold is primarily a defensive strategy, a way to preserve wealth during a currency crisis. If you want explosive generational returns, the kind that truly make a difference, you need leverage, and that leverage is found overwhelmingly in silver. Silver is often called the poor man's gold, but that completely misses its dual function and its incredible potential volatility. Silver is both a monetary metal, like gold, and a critical industrial commodity, unlike gold. Approximately 50% of the annual silver supply goes into high-tech industrial applications: solar panels, electric vehicles, medical devices, and electronics. This demand is structural and non-negotiable. It cannot be replaced easily due to silver's unique conductive properties. The key to the 6-year explosive bet is the confluence of two events: the industrial demand surge, hitting a supply cliff, combined with the inevitable rush of financial demand as investors panic out of paper assets and into precious metals. Let's look at the supply side. The world's silver inventories, particularly those available for immediate delivery on exchanges like the COMEX, are dwindling rapidly. We are seeing massive inventory depletion. Why? Because primary silver mining has been in decline for years. Most silver is produced as a byproduct of mining-based metals like copper, lead, and zinc. When economic uncertainty hits, base metal mines reduce production, inadvertently choking off the supply of silver. Furthermore, the grades of silver being mined globally are continuously declining. Miners must dig deeper and process more ore, increasing their energy and operational costs significantly just to maintain current output. The era of easy, high-grade silver deposits is over. Finding and permitting new, world-class deposits takes over a decade, meaning the current supply deficit is structurally locked in for the next 6 years, regardless of price signals. This structural deficit in the physical market is what separates the current cycle from all previous cycles. We are not just waiting for financial demand to pick up. The industrial market is already eating through available physical supply. Now, consider the gold-to-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, the ratio has averaged around 15.11, reflecting the physical ratio found in the Earth's crust, or 40.1 during periods of monetary stability. Recently, the ratio has often hovered near 80.1 or even higher. This is a historical anomaly created by the dominance of paper markets and the suppression of true price discovery. When gold begins its inevitable monetary ascent, driven by central bank failure and runaway inflation, silver will not merely follow, it will overshoot dramatically, seeking to correct that extreme historical imbalance. If gold goes from, say, $2,000 to $5,000 an ounce, silver will move much faster. If the ratio corrects even halfway back toward its historical average, say 51, silver's price appreciation will dwarf gold's, offering a leverage factor of 2 to 3 times. This is where the exponential returns lie, and this is why silver, over the next 6 years, represents the single most compelling asymmetric risk-reward proposition available in the market. This impending financial crisis is not something we can wait out in cash. Cash is the liability of a failing government system. This crisis is not one to be avoided. It is one to be mastered by positioning oneself in the correct assets, the assets that cannot be inflated away. My firm conviction is that we are on the cusp of a catastrophic failure of confidence in fiat currencies. When that happens, the fractional reserve system will be severely tested, and the public will finally realize the colossal difference between owning a paper contract that promises physical delivery and actually holding the physical metal itself. The scramble for physical reality will lead to unprecedented price discovery in precious metals. I have established the why, the inescapable collapse of the debt paradigm, and the what, physical silver and gold, with silver acting as the main engine for appreciation. We have secured the foundational understanding of the macro environment and the unique critical supply-demand dynamics that guarantee price pressure over the next 72 months. However, simply buying a physical coin or bar, while prudent, is not the most efficient way to capture the maximum upside potential that this 6-year cycle promises. To maximize the returns, we must apply a specific, highly leveraged investment strategy focusing on the producers and developers that are best positioned to capitalize on this massive coming repricing. The true art of this trade is not in the metals themselves, but in the companies that mine and develop them. In a high-inflation, rising commodity price environment, the operating leverage of a quality mining company, where their cost basis is relatively fixed but their revenue is soaring with the commodity price, offers returns far exceeding the commodity's price movement itself. But not all miners are created equal. Many are burdened by unsustainable debt, poor management, or politically unstable jurisdictions. Identifying the premier operators, those with high-grade, low-cost assets in safe jurisdictions poised for massive expansion, is the final and most crucial step in this multi-year investment plan. That is the leverage that turns excellent performance into generational wealth. We are standing at the threshold of a massive, unavoidable shift. The financial world as we know it is ending, and a new paradigm, one rooted in physical value, is being born. The time for caution is over. The time for strategic, aggressive action is now. Stay tuned for Part 2, where I will reveal the specific structure of my holdings, the exact categories of companies, the critical metrics I use for selection, and the investment vehicles that I am betting on to deliver exponential returns during this critical 6-year window. We will move beyond the macro to the micro, detailing the specific names and strategies that will capture the coming wave of wealth creation. We stand now at the precipice. I have laid out the undeniable macroeconomic reality. The central banks have painted themselves into a corner with sovereign debt levels that are mathematically insurmountable without massive, continuous monetization. The first part of this discussion focused heavily on the why, the necessity of escaping the fiat structure. Now we move definitively into the how, focusing on the precise mechanics of wealth preservation and, more importantly, extraordinary wealth accretion over the next 6 years. This is where I am placing my chips, and I urge you to study the underlying logic meticulously, for this opportunity represents a generational transfer of wealth that rewards foresight and courage. The initial strategy is simple, almost brutally so, but the execution requires discipline. We must own physical metal, and we must own the levered vehicle of the metal. If the next 6 years confirm my thesis, a sustained exponential destruction of purchasing power in every major fiat currency, then gold and silver are not merely insurance. They are the destination of capital fleeing systemic instability. Let me reinforce the specific timeline, 6 years. Why this horizon? Because it allows the inflationary impulse, which is currently dismissed as transient or transitory, to fully embed itself into the cost structure of the global economy. It is the necessary duration for the massive underinvestment in the mining sector over the last decade to translate into genuine, crippling supply deficits, regardless of price signals. And crucially, 6 years is enough time for the average sovereign debt ratio to force central banks into explicit yield curve control, which is nothing less than the overt admission that inflation is the preferred mechanism of default. My bet is predicated on 2 interconnected realities. First, the inevitable collapse of the gold-to-silver ratio. Historically, this ratio averages somewhere in the 50.1 to 60.1 range. Today, it still lingers at levels far too high, reflecting a misunderstanding of silver's dual role. Silver is not just gold's little brother. It is an indispensable industrial input, essential for solar power, electric vehicles, and emerging high-tech applications. As the world transitions toward electrification and greener technologies, the demand side for silver is structurally increasing. At the same time, silver is overwhelmingly produced as a byproduct of base metals mining, copper, lead, zinc. When economic turmoil slows base metals production, the silver supply suffers disproportionately. This creates a supply-demand squeeze that is unique to silver. Therefore, while gold provides the stability and the initial flight capital destination, silver provides the leverage. If gold moves from, say, $2,000 to $5,000, a remarkable gain of 150%, I fully anticipate silver, having begun its run from depressed levels, to move from $25 to perhaps $150 or even $200. This is not hyperbole. It is a function of the physics of scarcity meeting explosive demand and relative undervaluation. My heaviest weighting is focused on silver, both physical and in quality mining equities, expecting the gold-to-silver ratio to compress sharply, likely heading back toward the 30.1 range, perhaps even lower. That is the leverage component of the bet. The second core reality is the critical importance of unhedged mining equities. This is where most investors falter. They recognize the metal's potential but fail to capitalize on the operational leverage of the mining company itself. Let us perform a simple mental exercise. Assume a miner has an all-in sustaining cost, AISC, of $1,200 per ounce of gold. If the price of gold is $1,800, that company makes $600 per ounce. Now, imagine gold surges to $3,600. The cost structure, $2,200 AISC, remains largely stable, but the profit margin jumps from $600 to $2,400 per ounce. The company's profit has quadrupled, even though the gold price merely doubled. This operational leverage is the engine of exponential returns. But this only works if the company has not sold its future production forward. It must be unhedged. Hedging, a practice prevalent among major miners during the 1990s and early 2000s, transfers the upside to the commercial banks. We want the full exposure to rising metal prices. Therefore, my entire focus is on selecting small to mid-cap producers and advanced developers, the juniors, that are unhedged, operate in safe jurisdictions, and possess genuine exploration upside. This brings us to the crucial open loop, the supply destruction narrative. Over the last decade, generalist investors abandoned the mining space. Capital became scarce. Companies struggled to fund exploration and development. This has led to a depletion of Tier 1 reserves. It takes, conservatively, 10 to 15 years to take a significant discovery from initial drill hole to commercial production. The supply pipeline is withered. Even if gold hits $5,000 tomorrow, we cannot flip a switch and triple production. This scarcity creates the fertile ground for the ultimate climax of this investment cycle, the M&A wave. When the price of gold and silver enters a sustained bull market, the majors, the Barricks and the Newmonts, who have burned through their reserves, will be forced to acquire the junior producers and developers to replenish their pipelines. They will not be able to rely on organic growth alone. These acquisitions will be strategic, aggressive, and highly dilutive to the buyers, but massively rewarding to the target shareholders. We are already beginning to see the early tremors of this consolidation, but the truly lucrative phase begins when the metal price is high enough that the majors are overflowing with cash flow, and the pressure to replace reserves becomes overwhelming. The 6-year horizon provides ample time for the quality junior companies we identify today, trading at depressed valuations relative to their underlying mineral wealth, to be acquired at multiples that generate 10-to-1 returns or higher. My entire strategy is built around identifying the future acquisition targets, the companies with high-grade, low-cost deposits, run by competent management teams who are aligned with shareholder value. Let us now delve deeper into the systemic shift that provides the necessary tailwind for this entire trade, the demise of faith in central banking models. The current monetary regime is essentially a confidence game, and confidence is eroding rapidly. We are seeing central banks led by those in emerging markets but increasingly mirrored by the major players, aggressively repatriating and accumulating physical gold. Why are sovereign nations buying gold at these levels? Because they recognize the endgame. When the dollar system fractures or when sanctions risk escalates, the only asset that holds intrinsic sovereign value is physical, unencumbered gold. This central bank demand floor fundamentally changes the structure of the gold market, providing a relentless, price-insensitive buyer that will keep supply tight and prices buoyant, regardless of short-term paper market manipulation. This leads us to the crucial role of the paper market, specifically the COMEX futures exchange. For years, the paper price has suppressed the physical price, allowing speculators to create claims on metal that far exceed the available deliverable inventory. This system, however, is inherently unstable. When true physical stress occurs, triggered by large sovereign purchases or a loss of confidence among large institutional investors, the paper market will experience a massive short squeeze. The current supply chain, already fragile post-pandemic, cannot handle a coordinated push for physical delivery. The ensuing panic will cause a price discovery event where the paper price must rapidly align with the soaring cost of procuring actual physical metal. This is the re-engagement point, the Dow to gold ratio. When I look out 6 years, I do not just measure the price of gold in rapidly devaluing fiat dollars. I measure it against assets that are inherently prone to bubble formation, specifically major equity indices. The Dow Jones Industrial Average relative to the price of an ounce of gold is a powerful indicator of market sanity. Throughout history, this ratio has typically bottomed around 5:1 or even 1:1, meaning 1 ounce of gold could buy the entire Dow index. Today, the ratio is far higher, signaling extreme speculative excess in equities relative to real assets. My forecast for the climax of this cycle is the dramatic compression of this ratio. As the equity markets, bloated by years of quantitative easing and leveraged speculation, eventually face the reality of higher sustained inflation and rising real rates, or the threat of them, they will enter a prolonged period of stagnation or decline. Simultaneously, gold will surge. The convergence will be swift and brutal for those holding paper wealth. We are betting that the Dow to gold ratio will fall dramatically, representing not just a hedge against systemic collapse, but a massive transfer of capital from the inflated, leveraged equity bubble into the safety and scarcity of physical assets. Let's focus now on risk mitigation and the specific composition of the portfolio. The 6-year time frame necessitates resilience. We must accept volatility. Precious metals miners, particularly the juniors, are highly volatile assets. They are leveraged to the underlying metal, and they are leveraged to sentiment. During inevitable market corrections, these stocks can be hammered. The key is to view these periods not as threats, but as mandatory accumulation opportunities. True value investors buy when others are forced to sell. Our conviction must be absolute, stemming from the undeniable math of sovereign debt and fiat currency failure. In terms of jurisdiction, the global geopolitical landscape is crucial. We prioritize companies operating in geopolitically stable regions, Canada, Australia, certain parts of the United States, to mitigate the risk of resource nationalism, punitive taxes, or outright expropriation. Even the highest grade asset is worthless if the government takes control of it. Due diligence on jurisdiction and management track record is non-negotiable. Furthermore, we must address the silver deficit in excruciating detail. It is not just the industrial demand, but the sheer physical tightness. Unlike gold, which is mostly stored in vaults and rarely consumed, silver is consumed, meaning inventories are constantly drawn down. The largest investment silver inventories have been falling relentlessly, particularly in the COMEX registered category. This inventory depletion acts as a ticking time bomb. Once those registered stocks hit critical low levels, the paper market will struggle violently to satisfy even minor spikes in physical demand, leading to the explosive price discovery I anticipate. For silver, the focus must be on primary silver producers, companies whose main revenue stream is silver, rather than those relying on it as a byproduct. These primary producers are few, and their scarcity makes them inherently higher leverage bets in the coming surge. The definitive conclusion of my 6-year bet centers on the profound scarcity of good money in a world drowning in bad debt. When historians look back at this decade, they will recognize that the world had two choices: accept an orderly, painful deleveraging and deflationary bust, or monetize the debt and accept currency devaluation. Every major central bank has signaled, implicitly and explicitly, that they choose the latter path. Inflation is the policy, not an accident. This chosen path guarantees the success of the gold and silver trade. By the end of this 6-year window, I anticipate gold will be trading well above $5,000 an ounce, possibly testing $8,000, driven by persistent inflation and the flight from treasury bonds. Silver, the higher octane fuel, should have achieved its price relative to gold, pushing it into the triple digits, likely sitting between $150 and $200 per ounce. The greatest returns, however, will not come from holding the physical metal alone, although that is essential for portfolio ballast. They will come from the carefully selected, unhedged junior mining companies that successfully navigate the exploration and development phase and are ultimately acquired at premium valuations. These companies represent the ultimate leveraged play on the inevitable monetary reset. This is not a momentum trade, it is a structural trade. It requires patience, deep research into management and metallurgy, and the intestinal fortitude to ignore the daily noise generated by short-term market fluctuations. The underlying theme remains constant. The weight of global debt guarantees the devaluation of fiat currency. Physical gold and silver are the only financial assets that simultaneously benefit from the accelerating decline of purchasing power and are outside the control of the central banking system. Therefore, my unwavering focus for the next 6 years remains concentrated. Physical accumulation of gold and silver, especially silver, combined with strategic, highly concentrated investments in the best managed, unhedged junior and intermediate producers. This is the strategy designed to capture the generational wealth transfer that is already underway. Do your homework, study the costs of production, scrutinize the balance sheets, and align yourself with assets that cannot be printed into oblivion. The time for deliberation is over. The time for action, guided by rigorous research and conviction, is now.